Hi, everyone, and welcome to this lecture video on step 5 of the accounting cycle, which is adjusting entries. And where we left off in the last class, we were here, right, at the trial balance, and specifically it's referred to as the unadjusted trial balance. And the reason it is unadjusted is because we have not done the adjusting entries yet. So let's see why we need to do adjusting entries. Well, the trial balance that is unadjusted is missing some things. Okay, let me explain what I mean by that. What we learned in step 2 of the accounting cycle on journal entries is that we're recording transactions, okay? And transactions, again, are an exchange of value. And in that exchange, there's some kind of a physical exchange. By that, I mean usually like an exchange of cash, or if it's not an exchange of cash, there's some other document, whether that's an invoice, a bill, a contract, some kind of physical object that changes hands, okay? But sometimes things happen and there is not an exchange of something physical, like there's no cash, there's no bill, there's no contract, but still there's some kind of revenue or expense, that takes place, but they were not captured in step 2 because at that point in time, there was not an exchange of cash or some other physical object. Okay, so we need to capture all of those things. We want to make sure that our financial statements and everything include everything that happened, all the revenues, all the expenses. So there are 4 different types of adjusting entries. Okay, 2 of them we've already learned about: prepaid expenses and unearned revenues, right? We've already learned about these 2 in class. And we are also going to learn about 2 others: accrued expenses and accrued revenues. And you see that in each of these scenarios, there is cash that is changing hands at a different time than the revenue or expense. Okay, so these 2 columns here represent the period. Either something is happening in the earlier accounting period, and then something else is happening in the later accounting period, right? So in prepaid expenses and unearned revenues, cash is changing hands first, and it's the opposite for accrued expenses and accrued revenues, meaning you pay for something or you receive cash after the revenue or expense, okay? So we've already been over the 3 key concepts that you need to know in order to help you analyze adjusting entries: the time period assumption, the revenue recognition principle, and the expense recognition or matching principle. So please don't forget those. They are crucial to understanding adjusting entries, okay? And then a couple other tips that I want to help you with adjusting entries is I think it helps a lot to utilize timelines so you can figure out what is happening when. And I've already shown you some examples of that in class, but we'll look at some more examples of that in our examples in this video today. And also, your adjusting entries have to be real. Okay, what does that mean? Well, first of all, you need to know that our REAL stands for revenue, expense, asset, liability. Okay, these are 4 terms that you should already have learned and already started to be comfortable with. If you're not comfortable with them, look at this slide, take a picture of it, make yourself flashcards so that you do not forget the meaning of these 4 terms, okay? You've got to understand those in order to be able to properly analyze adjusting entries. Okay, now when I say adjusting entries gotta be real, this is kind of how you can check your work or help you with your transaction analysis. So first of all, every adjusting entry does two things, okay? First, it records either revenue or expense. So in every adjusting entry, there will be a revenue or an expense. And every adjusting entry will adjust an asset or a liability. And when I say adjust, I mean it's either going to increase the asset or liability or decrease the asset or liability. So bump it up or down, okay? So every adjusting entry will have revenue or expense and asset or liability. So we're going to start first in this video looking at prepaid expenses and unearned revenues. And we're going to start first with prepaid expenses. So we learned in our last class that prepaid expenses are when you pay first for expenses used later. And the example we looked at was insurance. We pay first for an insurance policy that's going to cover us for the next 6 months. And when we first purchased that insurance policy, this was the transaction analysis we did. We had one asset, cash, going down, one asset, prepaid insurance, going up. Okay. But now it is the end of the month, okay? And this is where the timelines come in because it's really important to know where we're talking about. Okay, now it's the end of the month, okay? And adjusting entries are performed always at the end of the month to capture anything that we missed in our regular journal entries. So we see it's the end of the month, okay? Now what's happened in that month is two things, okay? We've used some of that insurance policy, and the 6 months of benefit have been reduced. Okay, now one of those months has been used up, it's gone away. That leaves only 5 months left. So our adjusting entry has to do both of those things. Now we didn't pay any more cash. We didn't sign a new contract or anything like that. That's why sometimes if you don't think about it, you might miss it. That's why we have this important step of adjusting entries to make us think about what's taken place during the month when there's not that exchange of a physical object. Okay, so let's take a look at our transaction analysis now that it's the end of the month. Okay, so again, we got to make sure that it's real. Is it revenue or expense? And then what's happening to our asset or liability in this case? Well, in this case, it's an expense because we've used something up, right? We've used our insurance, and our asset or future benefit of future insurance is going down because we went from 6 months to now having 5 months left. Okay. So this is going to impact expenses, and it's going to be an asset going down. So you see in our transaction analysis, we've got -100 under prepaid insurance. That's our asset going down. And then we also have our expense, which our expense is always going to be decreasing equity. Okay. Now it's really important that you note that what we are looking at is the change. Okay, your adjusting entry needs to be the change in the account. So you wouldn't put, sometimes students want to put 500 in there because they're like, oh, well, there's only 500 months of insurance left. Yeah, that's true. But that's not what our entry is. Our entry is the change in the account, the decrease in the account, not the balance. I'll show you how it all rounds out at the end. Okay, so again, when you're doing adjusting entries, it's kind of like the same process that you did here. Okay, you got to analyze, record the journal entry, and then post. So that's why you see here under step 5, there's actually 3 steps. You have to analyze, record the entry, and post. So let's take a look at that. Right, we analyzed the entry, right? We put it into the accounting equation. Right here, our assets are going down, and we've got expenses making equity go down, and therefore our accounting equation balances. We use that transaction analysis to put together our journal entry. So we're going to debit insurance expense and credit prepaid insurance using our handy dandy debit and credit rules on our Post-it. Then you post it to the ledger. So we've got here in our ledger the credit to prepaid insurance and the debit to insurance expense. And now here, when you go to calculate the balance in prepaid insurance, you take your total debits and you subtract out your total credits, and then you get your balance. Now you see the balance reflects the remaining future benefit of 5 months. Okay, the balance will reflect what's left over. All right, so that is prepaid expenses. Now, some other examples of things that kind of act like prepaid expenses are things like supplies, right? Because if you think about it, you buy your supplies first and they sit in your stock room and then eventually you use them. Same thing with equipment, whether that's your office equipment, whether that's a machine, a tractor, even if it's like a building or furniture or something that you own, you buy it first and then you use it over time. And we're going to talk more about that process in class on how specifically we deal with supplies and equipment, but essentially it's the same concept, okay? You buy an asset first, and then when you use it, you record the expense and you record the future benefit of the asset going down or decreasing. All right, next let's move on to unearned revenues, okay? Unearned revenues, as we learned in the previous class, are that the customer paid us before we provide the service, okay? And the example that we came up with that we have already discussed is when a customer pays today for 3 months of future consulting services, okay? So when we initially did our transaction analysis, we recorded cash increasing because we received cash, and we recorded a liability increasing because now we owe. We owe those services. Okay, so that's the key definition of liability you need to remember. We now owe those services to our customer over the next 3 months. So when we get to that very special, important day, which is the end of the month, which is when we record our adjusting entries, now we're here in the timeline. And we go, okay, well, a month has gone by, so we performed some consulting services. So that means when we perform the service, we have now earned revenue. Okay, that's that revenue recognition rule. We've earned revenue. And also, our liability, or the amount of services we owe, has gone down. We don't owe 3 months of service anymore. We only owe 2 months of service. Okay, so to figure out how much each month of service is worth, you take the total amount of $450, you divide it by the 3 months, and that tells you it's $150 for each month of service. That means we've now earned $150 of that $450. So let's take a look on how this would be analyzed. Again, every adjusting entry, it's got to be real. So in this case, we're going to record consulting revenue. Okay, because we've earned it, we've performed the service. Now, again, when that happens, we don't sign another contract. They don't pay us any more money because they already paid us. So there's not anything physical really changing hands there. But still, at that point, we've done the work, so we've earned it. And then our liability is decreasing, okay, because what we owe them, we've already given them 1 month of service, so we don't owe them 3 anymore, we owe them 2. So the liability or debt is going to go down. Okay, and again, when we do our adjusting entries, we've got to go back through the regular 3 steps that we do, which is analyze, the transaction, record the adjusting entry, and then post to the ledger. So at this point, you see that we are going to record a decrease to the liability account. So we're going to reduce our liability by 150, and then we're going to record our revenue because we've earned it, we performed the service, and the liability and the equity offset each other, a minus and a plus. That gives us 0 on this side, and there's nothing in the asset side. So therefore, our accounting equation balances. So our transaction analysis is done. Then we go ahead and record our adjusting entry. We use those same debit credit rules we used before, and we're going to debit unearned revenue, which is our liability decreasing. And we're going to credit consulting revenue, because revenue is always a credit because it always increases equity by definition. And then we go and post it to our ledgers. So you see here we have a debit to unearned revenues and a credit to consulting revenue. And this is where now when you calculate your new balance in the liability account, that's where you see 300 now in unearned revenues, which reflects the remaining 2 months of service owed. So again, your entry is the change in the account, and then your balance or what's left will come out at the end. Okay, so that is prepaid expenses and unearned revenues. In the next video, I will explain accrued expenses and accrued revenues.